The Equal Credit Opportunity Act is a consumer protection statute that protects against discrimination. A creditor cannot discriminate against any applicant with respect to a credit transaction. 1. On the basis of race, color, religion, national origin, sex, marital status, or age. 2. Because all or part of the applicant's income derives from any public assistance program, or 3. Because the applicant has in good faith exercised any right under the Consumer Credit Protection Act. Before the ECOA was passed, discrimination was widespread in creditors approving or rejecting applications based on gender, marital status, and membership in racial minority groups. Women were often denied credit whether they were single or married. In the worst case, some creditors would require proof of a wife's birth control or sterilization before guaranteeing a married couple a loan. Creditors often denied loans to African Americans. Even if a bank were to approve a loan for an African American to buy a house, the bank would require a substantial down payment and the mortgage would be uninsured. In 1974, Congress passed the Equal Credit Opportunity Act, but the act's focus was on discrimination against women and married women. 2 years later, the act was amended to prohibit credit discrimination on the basis of race, color, religion, national origin, age, the receipt of public assistance income, or good faith exercise of any right under the Consumer Protection Act. There are 3 ways in which a plaintiff can prove an ECOA violation. 1. Direct evidence of discrimination. 2. Disparate treatment. 3. Disparate impact. A plaintiff with direct evidence of discrimination by a creditor has a rare claim under the ECOA. In one case, a white plaintiff applied for a farm loan, but was denied. When he received his application back, the application said he was denied because he was white. On the face of the application, the creditor wrote, "No whites." Most plaintiffs do not have direct evidence of discrimination. Therefore, they have to try to prove discrimination under disparate treatment or disparate impact. Under disparate treatment, a creditor must intentionally treat some applicants or borrowers more favorably than others, although all are similarly creditworthy. Federal courts have used different tests when deciding if a plaintiff can prove a prima facie case, and this has caused many problems. For example, Cooley, an African American credit applicant, had his case dismissed because he couldn't prove white applicants who received credit from the same bank were similarly situated to him. Cooley applied for a line of credit at Sterling Bank. He was in the range of excellent credit, his household income was over 6 figures, and he had millions in assets. Still, the bank denied his loan. The bank stated they were concerned about his other lines of credit he had opened at other banks, but he had consistently paid the monthly amount due. Cooley then filed a claim under the Equal Credit Opportunity Act with direct and circumstantial evidence. Under direct evidence, he had a board member testify that during a board of directors meeting about his loan, many of the directors made racial remarks. One was, "There's no way that a black man can come in here and get money from a bank." The court said this one isolated remark wasn't enough to prove discrimination, but Cooley also had circumstantial evidence. He showed that other similarly situated white applicants received loans, while he did not. The court still denied his claim. But why? The court stated the applicants Cooley compared himself to were too dissimilar, although he had presented 20 other loan applicants. Cooley's situation is just one of hundreds whose equal credit opportunity claims were denied. More often than not, plaintiffs' claims are dismissed or summary judgment is granted against them. Lastly, under the disparate impact analysis, a plaintiff must show the lender applies a neutral practice to all credit applicants, but the practice has a disproportionately adverse effect on applicants or borrowers from an ECOA-protected class. The leading case is Cherry v. Amoco Oil Company. The plaintiff in Cherry was a white female applicant who applied for a gasoline credit card and was denied. She alleged her denial was based on the company's credit scoring system's use of her zip code, which was a predominantly African American neighborhood. Her evidence showed that her current zip code was rated at 1, and if she had lived in a different area, her credit card would have been approved. Once again, the court held she did not prove her case. Since the plaintiff did not have any data showing approval for other applicants similarly situated to her, the court ruled there was no disparate impact. Regulation B was created by the Federal Reserve Bureau. Regulation B works with the Equal Credit Opportunity Act to ensure there is no discrimination when protected classes apply for loans. The procedural safeguards in Regulation B begins when an individual applies for credit and until the loan is issued. Although Regulation B is supposed to work with the Equal Credit Opportunity Act, it actually hinders plaintiffs from bringing a successful claim under the Act. Regulation B prohibits creditors from collecting data on ECOA classes. Initially, this makes sense. If creditors cannot ask about an individual's race, religion, or gender, then they cannot discriminate. But, in order to prove a successful claim under the Equal Credit Opportunity Act, a plaintiff has to prove that similarly situated applicants received loans while they did not. If creditors do not collect this data, then plaintiffs cannot prove their claim. The Federal Reserve Bureau has acknowledged there is still widespread discrimination in credit lending, although the Equal Credit Opportunity Act and Regulation B are supposed to prevent it. Twice, the Federal Reserve Bureau has considered allowing creditors to collect this data, but ultimately decided not to. As of today, Regulation B still prohibits creditors from collecting this data. The courts have also acknowledged how it is almost impossible for a plaintiff to prove a case under the Equal Credit Opportunity Act without direct evidence of discrimination. The court in Cherry stated that the utilization of the effects test based on statistical methodology is apt to be quite difficult for a plaintiff because Regulation B prohibits a creditor from inquiring about the race, sex, and marital status of an applicant. Regulation B must be amended to allow data collection. This must be a mandatory requirement that all creditors who receive loan applicants must report this data to federal regulators and the general public. In 1989, Congress recognized racial discrimination in mortgage lending and required lenders to report collected racial data to federal regulators and the general public under the Home Mortgage Disclosure Act. The Federal Reserve Bureau can model this new rule off of the Home Mortgage Disclosure Act and implement similar guidelines. Without change, plaintiffs will not be able to prove discrimination under the Equal Credit Opportunity Act, and we will never know how widespread discrimination in the credit industry truly is.